I've found 5 cheap stocks investors are rushing into, one trading for 94% off its highs, one that is 73% cheaper than a competitor, and one at rock bottom valuation of just 6 times price to earnings. But these are not stocks you want to buy. Hey Bowtie Nation, Joseph Hogue here with what could be one of the most important lessons in investing, a mistake I've made myself and costing me $27,000, the urge to dumpster dive for your stock picks. Investors love to hunt for those bargain bin stocks, the ones with the biggest price drops, because hell, if investors loved it at $446, it must be a steal at $30 each. I'll show you why this is the worst investing strategy, along with what you should be doing instead. Along the way, I'll highlight those 5 cheap stocks investors are buying, why they aren't nearly as cheap as they appear, and reveal the stocks to buy instead. And our first not-so-cheap stock has been hitting investors for more than 4 years. Shares of Moderna, ticker MRNA, down 75% from the last year and crushed 94% from that giant $446 pandemic peak. And I get it, Moderna was the millionaire maker of the pandemic, rising from just $17 a share to that $446 in 1 year, 26 times your money. Investors are always going back to their old favorites, but calling Moderna cheap now is like saying that expired lottery ticket is a bargain at 50 cents. Folks, biotech is an extremely expensive industry, with Moderna chewing through more than $3.6 billion a year in research alone. And that means it is either blockbuster drug or bankrupt for most of these companies, and Moderna has been deep in the red for years now. The company booked a negative free cash flow of $4 billion last year, and while it does report $1.6 billion in balance sheet cash, it also owes over $1 billion in debt and needs a big drug approval fast to build back that positive cash flow. And it does not look like that's going to happen soon, with only a couple of drug approvals expected this year and next, with no real blockbusters until 2027 at the earliest. Until that time, shares of Moderna may bounce occasionally on a positive drug trial, but the trend is going to be flatline at best and put your money to sleep. Instead, shares of Eli Lilly, ticker LLY, are down 8% in the last year and an opportunity in a world-class drug maker. Shares of Lilly trade for 14 times on a price-to-sales ratio, more than 4 times more expensive than the 3.4 times valuation we see on shares of Moderna, but it's reflective in that momentum and the superior pipeline, growing revenue by 45% in the first quarter. Sales of weight loss drug Mounjaro alone were $3.8 billion in just the last 3 months, and just the company's top 7 drugs booked $8 billion in sales, nearly double from the year before. And Lilly's pipeline is always packed with late-stage Phase 3 testing drugs that could get the go-ahead within the next year. All this and with the financial firepower to acquire growth when it needs to. While free cash flow is occasionally negative under that expensive research cost, the company books $9 billion in operational cash flow to pay for it all. Nation, drug stocks are notoriously hard to analyze because you need that deep experience in the testing and the R&D pipeline to know when those blockbusters are coming. If you're going to be investing here, pay for the best, not the cheapest. I'm going to show you another not-so-cheap stock next, an iconic brand trading at a 73% discount. But more important than these stock picks is why chasing cheap stocks is such a dangerous strategy. Believe me, folks, I understand why investors love these stocks. Moderna was the millionaire maker during the pandemic, and if it snapped back to its peak, it is almost a 15 times return on your money. And when I say I understand the reasoning, it's because I've been there a lot. It was just 2 years ago I was sure ChargePoint Holdings was going to bounce back. The electric vehicle charging leader had seen its shares fall by more than 65% in 2 years. EV sales were growing at double digits, and the government was throwing billions of dollars at these companies. And I followed the stock all the way down from $4 a share, losing more than $27,000 on the company. And Nation, this was all after I had already worked as a professional analyst, working in the market for more than a decade, so do not feel bad if you've lost money on this strategy because it is extremely tempting. I'm going to show you those red flags to watch for next, but the problem here is the market is actually pretty smart most of the time. You got tens of millions of investors buying and selling, each pricing a stock on their own information, and all of it together, the bad along with the good, determines that stock price. And that means those cheap stocks are usually cheap for a reason, but not always a reason that's clear to investors. So I also want to give you 3 quick red flags to watch for before we get back to our list. First is just a heavy debt with a weak interest coverage, and I wanted to start with this one because it is usually the final push that causes a value stock to fall over the edge. Nation, bad things happen to good companies. From government regulations to just a bad economy, any company can fall on hard times, but it is the massive debt burden that limits a company's flexibility, and that almost always is the twist of the knife, so you need to know what to watch for in this. You start here with the balance sheet within the financial statements, and For example, you can see that long-term debt really skyrocketed in 2023 for ChargePoint. At that time, the company owed $316 million, more than 30% debt to its total assets. Now, companies can manage high debt, but if you also look at the income statement and this interest expense here, the annual interest payments on that debt of $9.4 million in 2023, it's almost $10 million the company just didn't have because it had also lost $341 million in operating income. This company was unprofitable like a brothel in the Vatican, and interest expense just kept on growing every year. Nation, I know this kind of deep analysis is a hell of a lot harder than just clicking on a video and letting some yahoo in a bow tie tell you what to buy, but if you are going to be investing your own money, and especially if you're going to be buying value stocks, you need the knowledge to do it right. Another red flag here is slowing or falling revenue, an easier one to find and just as bad sign for a stock. Here again in the income statement for ChargePoint, I should have seen that while 2023 saw amazing growth of 94% to $468 million that ignited the shares, the growth screeched to just 8% in 2024 and then started to fall. Of course, management had all these promises of renewed growth, but if you're taking that risk on those deeply discounted stocks, you better have more than just a promise to go on it. Last red flag here, and we'll get back to those not so cheap stocks, but watch for the high dividend yield with little or no free cash flow to back it up. Value investors have been chasing shares of Intel lower for years now and reasoned in 2023 that the 5% dividend yield was worth the wait, until the company cut that payout earlier that year, then paused the dividend altogether last year. But one look at the cash flow statement should have been a big warning. By 2022, the total dividends paid out amounted to almost $6 billion. The company didn't have that cash to spend. This line at the bottom, that free cash flow, is the cash left over from operating cash flow minus the investments the company needs to make to keep operating, essentially the cash left over for investors. And you can see here, even without that dividend, it would have been a negative $3 billion. That dividend helped send the company further into debt, from which it continues to struggle. Back to our list of cheap stocks with Target, ticker TGT, down 33% on the year and trading at the seemingly bargain bin price of 11 times price to earnings. That is 73% cheaper than the 41 times investors are paying for every dollar in earnings booked by Walmart. Target had a great iconic brand, and people want to believe that there will always be shoppers, but who of us old-timers remembers Kmart, 62 years as an American symbol before closing its final U.S. store last year? At one point, Kmart was selling its used mannequins to keep the lights on. Inflation has shifted consumer spending, evident in Target's 3% loss in sales since 2023. Lower and middle-income customers are trading down to Walmart and the dollar stores, while the higher end are going to smaller chains like Publix, leaving Target in a retail no man's land. The company is still free cash flow positive, but not by much when considering it's spending $4 billion a year to pay down its debt, pay its dividends, and buy back that stock. That doesn't leave much room for reinvesting in the business to compete. I'm going to show you a stock to buy instead next, but first, I want to thank today's sponsor, Fabric by Gerber Life. As parents, we all want our kids to have the things that we didn't. We try to prepare them for life, but what happens if you're not there to provide for them anymore? That's where Fabric and term life insurance policies come in. Term life insurance, like investing, is one of those things you don't want to put off. Right now is the time you want to lock in those low rates when you're young and healthy while you're still climbing the hill instead of being over it. Fabric has flexible policies that fit your family and your budget. It's made for busy parents like you, online and on your schedule, and you could be covered in less than 10 minutes with no health exam required. It literally took 6 minutes and 38 seconds when I applied online to get my rate and $700,000 in coverage for just $100 a month. And there's no risk with a 30-day money-back guarantee, and you can cancel at any time. Join the thousands of parents who trust Fabric to help protect their family. Apply today in minutes at meetfabric.com/Joseph. That's meetfabric.com/Joseph and get covered today. Another cheap stock here before I show you a better one to buy. And here, Skyworks Solutions, down 40% this year. And you would think a semiconductor company would be printing money in this market, but these aren't the kind of chips used in the AI and the data centers. You see, these are lower compute chips, mostly in smartphones. Mobile-related chip sales represent 60% of Skyworks' total revenue. And the biggest problem here, Skyworks depends on just one customer, Apple, for half of its total revenue, a customer it expects to lose market share this year. Now, this looks like a great value stock at just 2.7 times price-to-sales valuation and pays a 4% dividend while you wait. But it is a classic value trap with forecasted sales down between 8 and 6% this year and next. Instead, a chip company benefiting from that AI arms race, Marvell Technologies, ticker MRVL, up 18% over the last year. Marvell is focused on tomorrow's chip segments, AI accelerators, cloud, and automotive. Its custom silicon is a competitive advantage for cloud computing, and if you're looking for a company benefiting from that massive spending by the hyperscalers, this is it. Marvell doesn't look cheap at 10 times on a price-to-sales basis, almost 4 times the valuation on Skyworks, but that current valuation is a discount for the 18 or 13 times investors were paying for the stock just last year. And again, you pay for that momentum and the strength. Instead of losing sales like Skyworks, Marvell is forecast to see revenue jump 43% this year, making that stock valuation look like a steal. We've still got 2 more cheap stocks to avoid and 2 stocks to buy instead, but while that dumpster diving for stocks can rot your money, there is one strategy that works a lot better: buying stocks that have already gone up. Research by Jagadish has shown that stocks with rising prices over the last 6 months have outperformed in the following 6 months. Another study by Gray found that buying the previous 6 months' winners led to a 19% annual return versus the value stock strategy. And folks, this strategy goes beyond just chasing the winning stocks because, again, in a market of tens of millions of investors, those rising stocks are doing well for a reason. Strong growth and solid fundamentals are attracting more investor money, pushing the prices up. As hard as that $27,000 lesson in ChargePoint was, I changed my strategy right there and started chasing the winners and others. I started buying shares of Symbotic last year at $23 a share and kept buying all the way up to $27 each. I'm glad I did, with the stock now to almost $54 and a profit of $148,000. Another example of this strategy, I knew I was getting in on a big shift buying the Ethereum Trust, the ETH, in June at $23 each and just kept buying, even as the rest of the market clued in. It's now up to $35 a share and I'm still buying more. Nation, you can still look for those cheap stocks, and I'm going to show you how to do it right later, but when you find a winner like these, you load up and hold on. I've been warning on shares of Intel, ticker INTC, for years, down 35% just over the last year and under $20 a share. And this one is a lot like that target play. The old-timers like myself remember when Intel was the chip maker, leading in that cutting-edge tech and making investors rich. But then Intel lost its edge, got pushed out by NVIDIA and AMD. I pointed that out in 2022, that the company's dual strategy of manufacturing and design was just a lose-lose situation. The company barely had enough cash flow to do one strategy right, and instead, it split its resources to do neither well. Instead, though, I'm buying shares of Broadcom, ticker AVGO, already up 96% in a year, but with that growth advantage Intel used to have. Few companies compete in the number of growth areas as Broadcom, with tech and networking, AI infrastructure, and custom chips, and I don't think any other company besides maybe NVIDIA has the breadth of competitive advantages. And while competition is going to be fierce in that AI networking boom, Broadcom already has industry-wide adoption with 60,000 plus AI cluster nodes running its hardware. The company's dominance in custom silicon switching and connectivity makes it the backbone of AI-focused data centers. Besides top-rate in-house development, Broadcom has been a genius at acquiring the best tech, especially recently with its VMware and Juniper networks. Like many of these best stocks to buy, AVGO doesn't look cheap at 24 times on a price-to-sales basis, but considering the company is growing these sales at 20% plus a year, it's one you want to be watching. I'm going to reveal another not-so-cheap stock next, and another value play that's actually a good deal, but all you out there in the nation know I'm a cheap ass to my bones. I go to Olive Garden and then leave after the free breadsticks. So I will never give up on looking for cheap stocks, but there is a way to do it right. Your cheap stock strategy has to be more than just, oh my god, Intel is down 58%, buy. And that starts with looking for the red flags I showed you earlier. Yes, it's more work, but if you had told me I'd be paid $27,000 for that time by doing that research and avoiding those shares of ChargePoint, well, doesn't that make it worth your time? Second here, you need to be actively looking for and understand the bear side of the story. This can be harder than it sounds because the financial media is overly positive, always looking for the bright side on a stock or just not saying anything at all. So look for the reasons investors are selling and give it just as much attention as the upside stories that you hear. Now, if there are no red flags and you've heard the other side of the story and still like the stock, honestly ask yourself, why is this cheap stock different? The market is saying it's a dog. Why do I think it's a diamond? And I knew I had that in shares of Super Microcomputer, ticker SMCI, when I started buying last November at $18 a share. Even though the stock had crashed 85% from its peak, even against the bogus allegations and the investors that said I was crazy, I did my research and have been buying ever since, building a position over $1 million in shares, up over $400,000 in profit. Back to our list, and shares of Centene, ticker CNC, down 66% in the last year alone, are the third worst stock in the S&P 500 index, and trade for what looks like a rock bottom 6 times price to earnings, less than half the 14x valuation it traded at as recently as last September. Healthcare is usually a safe, defensive play, and everyone needs insurance, so you would think this would be a no-brainer. A company selling something everyone needs. But then the margins on healthcare insurance have become razor thin. Centene books a profit margin of just 1.3%. For every $100 in revenue, it converts just $1 of that into profits. That doesn't leave a whole lot of room for error. And while during the pandemic, people paid their premiums but avoided those hospitals, now people are actually using their insurance, and it's costing insurers big time. Add to that the clawed-back subsidies and slow reimbursements by the government, and the entire health insurance industry is fighting for its life. And here shares of Humana are facing the same industry-wide problem in healthcare insurance, but is managing it better and could be a turnaround play in the space. The company manages to post positive operating profitability versus losses at Centene, and surprised the market on its recent earnings, reporting 10% revenue growth, sending the shares up 12% and raising its full-year outlook to a minimum of $128 billion. That's right at the analyst estimate right now, so it's likely the company is going to beat that too. Shares trade here for just 0.24 times on a price-to-sales valuation, a steep discount to its historical average. So while the industry headwinds aren't going away soon, this is a deep value stock and one investors can buy for a rebound. Check out Fabric by Gerber Life and use the link in the description to see why thousands of parents trust Fabric to protect their family. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.